Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Today, our guest is Dave Kranzler. Dave has nearly 30 years of experience in researching and analyzing and investing in financial markets. Dave co-manages a precious metals and mining stock investment fund in Denver, Colorado. And Dave publishes the Mining Stock and Short Seller Journal on his website, investmentresearchdynamics.com. And we are delighted to have him here today as a returning guest. Good day, Dave, and welcome again to SBTV. How are you doing?
Good, thanks. How you doing?
Yeah, we're glad you took the risk to come back one more time.
Nah, it's never a risk. It's always enjoyable.
Dave, let's start with the Fed rate hike. There's been a lot of interesting economic news in the last few weeks. The Fed funds rate. Fed Chair Jerome Powell informed the market last week that he or the Fed is nearing an end of its rate hiking cycle. And Powell also stated that interest rates are still low by historical standards. Uh, what do you think the Fed, or why do you think the Fed is now slowing the pace of rate hikes? And is it due to the U.S. economy doing a bit better right now and maybe not wanting to tinker with it?
That's a good question. You know, I haven't. I'd have to go back and count the number of interest rate hikes per year since they started hiking rates. I think they started in maybe December 2015. I think. Again, it's. I mean, to be honest, what they've done so far, I don't really consider an interest rate hike. I mean, we're up, what, about 2.5% from the bottom, I think. I mean, historically, when the Fed would start hiking rates, they'd go in 55 or 75 basis point chunks at a time, sometimes even more. And now they're doing, what I call quarter point nudges every 2 or 3 months or whatever, not even that frequently. So, and we're still, if you toss out what the government is telling us the inflation rate is with the phony rigged manipulated CPI measurement, if you use a real rate of inflation, if you took a basket of goods that people have to spend money on every day, and then tossed in, the cost of housing, the cost of all kinds of insurance, et cetera. The inflation rate is at least 6 or 7% and probably higher. I know John Williams spends a lot of time looking at all of these numbers, and I actually subscribe to his subscription service, and I don't even remember off the top of my head where he is estimating inflation to be. I think it's around 6 or 7%. And that's just using the way the government calculates inflation, I believe, in 1990, because every year they change how they manage the CPI basket. But at any rate, to circle back to interest rates, we're still, if you use a real inflation rate, we still have very negative real interest rates. So that is the Fed funds rate minus the real rate of inflation. And so when Jerome Powell referenced they want to raise rates to just below the neutral rate, he never specified what that rate is. Right. So, and as to whether or not they're slowing down the rate hikes or not, I mean, it's not clear to me that there was ever any kind of harried pace to the rate hikes. So, and they know if they were to start hiking rates quickly up to the neutral interest rate level for the economy, which would probably be, at least equal to the rate of inflation. So you're talking about, 5, 6, 7% on the Fed funds rate. It would crash the asset markets. It would crash the stock market, and they know that.
Yeah.
And they also know, I mean, they have better data than we get access to. They have better data than Wall Street analysts get access to. And I mean, they see the real raw. They have a whole economics department that, and all they do is go around the country gathering data. They know what's going on. So his speech, in my opinion, was not in response to the notion that maybe economic growth is decelerating. It's again, the only reason I think the Fed has been raising interest rates is to support the dollar, and the reason they have to support the dollar is it supports the Treasury issuance of the government. If the Fed, I mean, if the Fed stopped raising interest rates or started lowering them, the dollar would crash, or maybe not necessarily crash, but it would sell off precipitously, and it would take away the foreign bid for Treasury bonds because foreigners aren't going to buy Treasury bonds if they think the dollar's going to tank, right? Because then they're naturally losing money on their investment regardless of what the interest rate is on the Treasuries they buy. So that's kind of the razor's edge the Fed is walking right now is, to avoid raising interest rates at a pace and to a level that would pull the legs out from any kind of economic activity that's going on. It would pull the legs out from the asset markets, crash housing, crash stocks, etc., risk assets. But also they have to keep a safety net or support level below the dollar.
The Fed rate hikes have been strengthening the dollar, which makes U.S. exports less competitive. On the other hand, Trump is imposing tariffs on foreign imports to make U.S. exports more competitive. And they seem to be going in opposite directions. And all of a sudden, we have the Fed's announcement happening less than a week before Trump's trade war truce with China. Do you think this is a coincidence, or is there some perhaps cooperation between the Fed and the Trump administration to be better aligned?
That's a really good question. There's no question Trump is putting political pressure on the Fed to stop hiking interest rates. In terms of whether or not, I actually think Powell's, I think they've been they flow. If you look at what they do, they'll as soon as the stock market starts to fall, they say, oh, we're making progress on the trade war with China, and the stock market shoots up. And then a day later or 2 days later, as we saw this week, it comes out that we're no closer to reaching an agreement with China, and there's other issues going on, and then the stock market drops again. And so if you notice, pretty much on the same day that, or in successive days, all of a sudden trade negotiations were back on with China, and then Powell releases what's been called the Powell put speech, and the market shot up, I think, 700 points that day, or 800 points, I forget, somewhere around there. A lot of it, I think, is calculated because the stock market was getting ready technically to fall off a cliff at that point. And then all of a sudden, it's miraculously saved. So, and now we're back down to where we were a week ago. So I'm going to be curious to see, what kind of propaganda or sound bites they roll out to cause the trade, the hedge fund algos to pile back into the stock market again and chase stocks higher. So that's the game that's going on here.
Yeah, because obviously President Trump wants to keep the rates where they're at or possibly even lower them. And then we have Powell who wants to raise the rates. So we're in a bit of a tug of war. But if Dave Kranzler were to make the call on this, keeping the rates where they are or raising them, which would you do to have a better economy or to keep the economy strong?
I don't think it matters where rate. It's going to get to a point where it won't matter where interest rates are. I mean, the only reason that we've had any kind of positive economic activity over the last 10 years is because of all the money printing that the Fed did and the massive issuance of debt. And when you issue debt that's issued but not repaid behaves the same as printed money until you repay the debt. Well, the U.S. government hasn't paid down its debt level in decades. So you can look at the continuous increase in treasuries is the same thing as money printing, because when you issue debt, you spend it, the credit that you get, you spend the same way that you would spend hard currency in your pocket. So
Yeah.
debt that's issued but not repaid is the same as printed money. And that's the only reason that we've had any kind of economic activity, real economic activity over the last 10 years. And if you were to revise the GDP numbers by a real rate of inflation, the GDP deflator is where they remove inflation out of the numbers. If you were to use a real number for that deflator, we probably haven't had any real economic growth in the last 10 years since the great financial crisis. So, all of this, all the new cars driving around the street and all the new homes that have gone up, most of that's been financed with debt. And the debt's been possible because the Fed's kept interest rates low. So, again, it gets back to, all they did was fix the last round in 2008 by printing money and covering up the problems, and threw gasoline into the mixture by allowing more debt to be issued. So we still have the same problems. If I were in charge of economic policy, I would say, all right, let's step away from the markets. Let the market take interest rates where they should go. Let the market do with the stock market what should happen, and let the system naturally reset. I mean, there's natural laws of economics that are at play here that you can't defy. You can defer them, but you can't defy them. Let the natural law, and it's going to be painful for everyone. But if they had done this in 2008, I guarantee you, we would probably be talking about how that we're in the middle of a real bull market and a good economy at this point, as opposed to, quibbling over whether or not the Fed's going to derail a booming economy by nudging interest rates higher. It's complete Orwellian nonsense.
Yeah. The Fed talking about the end of the possibility of the end of rate hikes. Is this good for commodities and good for gold, silver?
Commodities that are highly dependent on global economic production, copper, iron ore, things like that, palladium, platinum. There's two forces at work with those types of commodities. You got inflation, inflationary forces, which are caused by money printing and, currency devaluation, which is what every country's been doing to their currency for the last 10 years. And then you've got actual economic demand. So I don't know to what extent price inflation or currency devaluation inflation will offset declining economic demand. I think that the semi-crash in oil prices that we've seen is a function of declining demand, which is a function of the global economy being a lot weaker than they say it is. Not conversely, but on the other hand, gold and silver are, they once Nixon closed the gold window, academics and Wall Street decided to lump gold and silver into the commodities basket, but they're not commodities. They're a commodity. A true commodity is a depletable product, is a depletable good. Okay, copper, it gets depleted. Silver to some extent gets depleted, but gold and silver are monetary metals. They've been monetary metals for the better part of 6,000 years, at least, that we know of. So, there's studies out there that show gold and silver have had, since 1971, have had their best periods of performance when the Fed is in interest rate hike cycles. And the idea behind that is that, the Fed is always behind the curve in terms of raising rates up to where the real rate of inflation is to get to a neutral rate. And so gold and silver, once the Fed starts hiking rates, gold and silver take off because, the gold and silver market realizes that there's heavy inflation coming because the Fed's kept interest rates too low for too long. We're in that situation now. On the other hand, if the Fed stops raising rates and takes them lower, you're going to have a dollar issue. The dollar will decline quite a bit, and that'll catapult gold higher. So, absent any kind of overt manipulation from the central banks, trying to keep a lid on the price of gold and silver. I think gold and silver are going higher regardless of what the Fed does. And again, it's a combination of the amount of fiat currency devaluation that's gone on globally for the last 10 years, and it's a function of the entire global economy is in horrible condition and getting worse, and in horrible financial condition, and has too much debt. So gold and silver are going to be, a flight to safety, and also your wealth protection from currency devaluation.
Yeah, I completely agree with you there. We'll get a bit more into to gold and silver, but I guess probably the biggest news this week so far was the yield curve inversion. U.S. Treasury yield curve between the 5 and the 3 year inverted for the first time in I think more than a decade. But given that both of them are short dated maturities, some people they don't think that the inversion is as significant as if it happened to, let's say, the benchmark 10-year bond. But having said that, for some of our listeners who may not be familiar with this market indicator, uh, can we get the Dave Kranzler definition of why the inversion on the yield curve happened?
Well, yeah, as you pointed out, it's been a slight inversion between the 3 year and the 5 year, and it's really, I mean, it's like a basis point. Where I saw the news was on zero hedge. I think
Mm.
the inversion between the 3 to 5 was exaggerated. I mean, yeah, it is significant, but it could also just be, a tech. When you're just talking about one basis point, it could be a technical issue. But essentially, the yield curve is extraordinarily flat, and is probably about as flat as it's been since right before the great financial crisis. And when people try to minimize the significance of a flat or inverted Treasury curve, or they come up with excuses for it, it's just Wall Street and the propagandists, the political propagandists, rationalizing away, oh, it's different this time. I mean, how often have we heard it's different this time in the last few years about
Yeah.
everything? Well, it's not different this time. A flat yield curve always, always, always implies we're either in a recession or heading into a recession. And the reason that happens is you get performance money that sees this. Smart money sees this, and they know the Fed's going to start backing off on interest rates, or they're going to
Right.
lower interest rates. And so they throw money into the longer end of the Treasury curve, because that's where they're going to get performance when the Fed starts taking interest rates back down. All right? You've got if you look at Treasury bonds as a lever, as interest rates come down, the Treasury bonds, longer Treasury bonds, are going to outperform on a price standpoint shorter bonds. So that's what causes the flat yield curve. People pull money out of short Treasuries and put it into long Treasuries, in anticipation that we're going to see much lower interest rates from the Fed down the road, because the economy is getting weak. And how do they try to stimulate a weak economy? They take rates to zero. So that's essentially, that's sort of the market explanation for what causes a flat curve. If you're flat the way we are from 3 to 5, I think it's just money shifting from 3 years out to 5 years, because when you're talking about billions of dollars, you try to squeeze out as much, even a couple basis points of performance makes a difference over the course of a year on how much you can earn on that, several $billion, tens of billions of dollars put to work in the Treasury market. So, and at some point we may see an inverted yield curve, which is to say that, the market essentially is saying, okay, Fed, you better take interest rates down, or, no one's going to be borrowing short-term money because it's going to be more expensive relative to long-term money. And, that's essentially where you got a liquidity problem, is when you've
Mm.
got an inverted yield curve.
Okay, so being that it's relatively flat, let's say it does invert at some point. How much of a runway do you think we would have before a recession would actually come on?
Well, again, I would argue that if you use a real GDP
Mm,
deflator that reflects the real rate of inflation, we've been in a recession ever since, the end of 2007. So, and the declaration of when the National Bureau of Economics, when they decide to declare a recession, it's a big political event, so it gets politicized. So when you look at the periods where they say that we've had a recession, oh, we've only had a recession for 6 months, huh? Is that right? And they don't declare that we've been in a recession until like a year or two later. So, um, but the numbers tell me, again, if I were to, impose a true GDP deflator on the GDP calculations, we've been in a recession this whole time. And there's secondary numbers and data out there that supports that. I mean, if you look at the average household, the average household in this country, its wealth position and its income position has not improved in the last 10 years. All of the wealth and income improvement over the last 10 years is concentrated in the upper 10% of households. And it's most highly concentrated in the upper 1% of households. And that's what the money printing has done. That's been the effect of inflation, of currency devaluation and money supply inflation. Is it's enabled the people who can take advantage of things like stock market inflation, like the stock market inflation we've seen since Trump got into office. You know, the average household doesn't really have exposure to the stock market other than maybe a pension fund that's, where they're in a pension fund that's wildly underfunded. So their pension fund's essentially insolvent anyway. So, yeah, if you're in the upper 10% of households in terms of economics and wealth in this country, yeah, you probably think the economy's been pretty good. If you're in the upper 1%, it's been a booming economy. And all these guys who get on TV and like Wilbur Ross and say the economy's booming, well, guess what? They're in the upper 0.5% of wealth and income. So that's who's benefited from from the economy over the last 10 years, or at least the Fed and the government's economic policies. I mean, I can't tell you how many conversations I've had over the last few years with friends who make a good living, and they're like, we have to use debt every month to make ends meet, and it feels like we're running on a treadmill. We're not getting anywhere, And I think that's what it's been for most of the country.
yeah, I guess that's where we had to invent a new word called the working poor. It's a bit
Well,
unfortunate.
you're in Singapore, so I mean, obviously Singapore has been, it's probably been a great economy for the last 10 years because
Yeah,
you've had a lot of capital move into Singapore and a lot of economic activity in Singapore, and there's been a large degree of financialization going on over there. So, Singapore is a different situation than it is here. But if you
yeah,
spent time over here in the United States, I think you'd see, and just drive around the middle class areas and the lower income areas. And it doesn't look like it's been 10 years or even 5 years or 2 years of a booming economy at all.
yeah. Okay. You touched on the stock markets, and in one of your recent articles, you described the stock market as the equivalent of Fukushima. How can yeah, can you enlighten us on that a bit?
Well, I think if the government and the Federal Reserve were to step away from the stock market and stop intervening, and the CME issued a statement 2 days ago that said they were intervening in S&P E-mini contracts every 10 seconds intermittently on Tuesday to prevent a larger sell-off in the stock market. So that's direct evidence that these guys are interfering in the stock market. If if and you've got the Working Group on Financial Markets, which was authorized by Ronald Reagan in 1989. I forget the number of the executive order that he signed, and that's become known as the Plunge Protection Team. And it's essentially the Working Group on Financial Markets is made up of a member from the Federal Reserve, the CFTC, the Commodities Futures and Trading Corporation, the Treasury Department, and there's one other seat, I forget. I think the New York Fed sits on it. The Working Group on Financial Markets has offices in the same building as the New York Fed in New York, and that's known as the Plunge Protection Team. And I think if these guys, if we could just turn a switch off on their operations, I think you'd see the stock market melt down very quickly. Obviously, it would have on Tuesday if the CME didn't step in the S&P E-mini futures to prevent those things from collapsing. So that's why I called it, referenced it, the Fukushima stock market. You know, it's on the verge of a meltdown, and it's going to happen. It's just a question of when.
Okay. So when the stock market does crash, do you foresee capital flowing into the U.S. dollar seeking some type of refuge before we see significant moves in gold, or would perhaps the dollar and gold rise together?
Man, you're asking some good questions today. You know, I think the flight to safety into the dollar is kind of it's a knee-jerk reaction, and I think a lot of it is done electronically and executed automatically. So, you know, we might see a brief pop in the dollar, you know, when the proverbial brown stuff hits the fan. But I do think that a lot of the money that's going to flow out of risk assets is going to go into gold. If you look at today, gold is up over $6 since the stock market started selling off. Gold is up again. I don't have the numbers right in front of me, but gold is up, I don't know, probably what, $20 in the last week or something like that.
Yeah.
And so to me, and I've made this argument in the past, like in same thing when the stock market started falling off a cliff in late January, gold had a big rally. And to me, that is your evidence that gold is starting to behave again as a traditional flight to safety refuge. And I think it will so more than the dollar. And I think at some point the dollar is going to fall, and that money, especially the foreign money that's in the dollar, is probably going to move into gold. And I think a lot of the smartest money is going to move into physical gold. So gold is up essentially about $42 since November 12th. Yeah. So in the last 3 weeks, 3.5 weeks, gold is up over $40. You know, and to me, that's your flight to safety right there. It's outperformed the dollar, it's outperformed the 10-year bond, and yeah, I think at some point we're going to see a massive rush, just like we did starting in October 2008. Gold was back then, it was close to $700 an ounce, and it eventually ran up to $1,900, and it only took 3 years to do that.
Right.
So I think we're going to see the same thing this time, and it might be more rampant than it was that time.
Okay. You also highlighted in one of your articles that mining stocks have not been cheaper in the last 78 years. With gold mining stocks already at lows, would a stock market crash drag this sector even lower, or how do mining stocks perform in a crash?
You know, again, I think that we've probably seen the sell-off in the sector that might have been correlated and, you know, at the start of a stock market crash. I think we've already seen that. I mean, yeah. you know, again, referencing 2008, the Huey index, the Amex Gold Bugs index, bottomed out. I think the low close was 145 or 150, and it might have traded around 141 intraday one of those days. That was like late October or maybe early November of 2008. And I thought we'd never see 150 again on the Huey index. Now, remember, gold back then was, you know, $700, and silver was, I don't know, it was around $8 or $9. And so if you look at the ratio of the Huey to gold, or the gold Huey ratio, I mean, I didn't think it would ever go get any worse than that. Well, now the Huey was like not too long ago. I think it was bottomed at 131.
Hmm.
And gold the whole time has been, above 1150. So gold's been, I don't know what, about 50, 55, 60% higher than it was in 2008 when the Huey was at 150. And so, in that respect, the mining stocks relative to the price of gold are cheaper than they were in 2008. I didn't think we'd get there, but here we are. So when I referenced the last 71 years, I think it was, that was based on there's a Barron's gold mining stock index that goes back to, I think, 1950 or 1951. And the ratio of gold to that mining stock index has never, I think in October maybe it bottomed out. It had never been lower than it was in October or September. And so to me, that tells me that the mining stocks are just ridiculously oversold. And if you're going to take risk anywhere in the stock market or anywhere in any asset market, I think you got to buy mining stocks.
Yeah.
If you look at what the Huey index did between early November and the end of the year in 2008, it more than doubled. It went from 150 to, I think it closed out the year a little over 300, and that was in 8 weeks. And that's how quickly these things can move.
Yeah. So
Um,
other base metals like nickel, copper, lead. How do you think they'll do? Would they still be undervalued or low risk at that
well,
point?
again, those products, those metals are based on industrial demand, and if we go
Yeah.
into a bad Well, as we go into a very bad global economy, I think the prices of those metals are going to continue to be depressed. Now, what could offset that is, China
Mm.
is sitting on more fiat currency than any entity in the world. I mean, just their currency reserves are enormous, and so China, I know China's been stockpiling a lot of these base metals. I know
Right.
they're stockpiling cobalt, they're stockpiling copper, lead, all of that stuff, lead, zinc. So, you could have some downside cushion there that would offset the lack of true industrial demand, with China just loading up on all these commodities. And I do think we probably will see that because, as they continue to dislocate from the dollar, which they've been doing. In fact, the whole Eastern Hemisphere has been, and wisely, in my opinion. Um, I think you're going to see them continue and accelerate converting their fiat currency holdings, euros, dollars, yens, and move it into hard commodities, and that would also probably include oil.
Okay. Swinging back up to the top where we spoke about Trump and the Fed. What are the chances of Trump signing an executive order to abolish the Fed?
I
Wishful
floated that
thinking,
idea
right?
out there, and someone's like, "Really? You think that's going to happen?" I just said it just sort of facetiously because Trump's when he first took office, he was whipping off executive orders like
It
like
was.
a racehorse out of loaded up on Lasix out of the gate. So, and he's kind of shown dictatorial tendencies. So, honestly, I don't think he would get away with that. I think if he thought he could get away with it, I think he would do it. And to tell you the truth, I think abolishing the Fed would be a good thing. Again, the Fed has acted. I mean, the Fed has been anti-capitalist because it tries to set the market rate of interest based on what it thinks is the true rate of the rate of inflation and the rate of unemployment, right? That's the goal of the Fed to maximize employment, minimize inflation.
Right.
So, I mean, they're humans and they're highly fallible, and they have been highly fallible. And now, in 1971, the one guardrail that was imposed on central banks was the gold standard, and that was
Yeah.
removed. So now, the infallibility has just gone haywire, and that's where we are now. So getting rid of that would be a good thing. I mean, the Federal Reserve was founded in 1913. Since 1913, the dollar has devalued 97 or 98% against gold.
Yeah.
So, I mean, that right there makes the case for getting rid of the Fed.
Okay. So let's say if by miracle, I guess, let's say Trump did abolish the Fed, Treasury took over the printing of money, how different would it really be?
It would probably be worse. Then you just have, then Trump would have direct control over the printing press, or the president would have direct control of the printing press. I mean, at least the Federal
Right.
Reserve has some sort of separation between printing money. I mean, that's why you see, in these countries where you've seen rampant inflation, Argentina, Brazil, and some of the third world countries, that's because the central banks don't have the separation from the government. The government they're basically run by semi-dictators, and that's, they print money like crazy, and that's what happens. So, at least having separation between the Fed and the Treasury has prevented hyperinflation. But I guarantee you, if Trump had his way, he'd be printing money and he'd have negative interest rates right now, and it would lead to hyperinflation. So, really, the answer is you got to go back to the gold standard. The gold standard has acted as the check and balance on human infallibility or human fallibility. So, and human error. And when you look at periods in history, I've seen data that goes back 1,200 years. The periods of history where it's pure gold standard is characterized by almost no inflation. And the periods of history where there's been fiat currencies, you get rampant inflation, and that's where we are.
Yeah. Some good words. I mean, I guess we should be careful what we wish for as far as abolishing the Fed, and maybe, hopefully, one day we could go back to some sort of a gold standard. But Dave, before we wrap up, could you tell us more about the journals that you publish at Investment Research Dynamics?
Sure. I publish the Mining Stock Journal, which is twice a month, every other Thursday, and it's I pontificate about my view of what's gone on in the markets and what's going on in the precious metals markets, and then I update the mining stocks that I've presented over the last since the journal started. I update those if there's been news and if I've had a change of opinion on any of them. And then if I come across a good new idea, I present that. And that's kind of the format there. And then the Short Sellers Journal is kind of self-descriptive there. That's weekly, that I send it out every Sunday, late afternoon usually. And again, there the first part of it is reviewing what happened with the key economic data released that week, and what I see based on my research as the reality of what happened versus what's reported, and then I tie in short sell ideas, based on where I think which sector I think is next going to sell off. I've been all over the housing market, and it's down over 30% since January. And lately I've been pulling in some other sectors. Last week I introduced a fantastic long-term real estate short idea. And it's not like I'm not like Dennis Gartman where I talk about my paper trades. I put my money where my mouth is, and I also present some put ideas if you don't want to short stocks outright, both
Right.
short-term and long-term put ideas. And I specify when I've bought puts, most of my capital is tied up in the precious metals market, so I don't always short stocks outright, but I buy puts, short-term and long-term, and I always lay those out on what I'm doing with my capital in terms of shorting the market in these journals.
Okay. Yeah. We're still a pretty small YouTube channel, but I don't think we would invite Dennis Gartman on the show anyway. So
It'd be fun to do it just to make fun of them afterwards.
I hear you. But Dave, again, we thank you for your time. And do you have a Twitter that our viewers can follow you on?
Uh, at INVRES Dynamics, or you just searched on Dave Kranzler. Um, and I think that's really that's the only social media I'm active on.
Okay. Anything else you'd like the viewers to know or share with them?
Sure, just real quickly, I actually had a subscriber ask me today, subscriber to my short seller journal, if I'd look at his portfolio, and I said, well, A, I don't have the time to do a proper job, and B, I don't want to put myself in a liability position. But what I told him was, I would not have any long exposure to the stock market other than mining stocks. And you probably want to move a fair amount of your investable funds into physical gold and silver. On my gold and silver investments of choice are 1 ounce bullion coins that are sovereign minted. It doesn't matter which sovereignty mints them, but those are the ones that are most identifiable globally and the hardest to counterfeit. So, if you're mired in a precious metals portfolio that hasn't done well over the last few years, hang in there, because when these things take off, they take off like the internet stocks took off in the late 90s.
Okay, good advice, Dave. Again, we absolutely appreciate it, and maybe we can do it a third time. Third time's the charm, but first and second time have been pretty awesome on its own as is.
Absolutely, Patrick. I've had a great time the first 2 times, and you can have me back whenever you want.
Great, we appreciate that.
I mean, I don't know if you wanted to use video for the podcast, but right now I think visually I'm not fit for human consumption.
Wait, you're the same guy that said you're good looking, so we can do video, right? That was Dave Kranzler from investmentresearchdynamics.com with his views on the economy and gold. To find out more about Dave's work, please visit his website, investmentresearchdynamics.com. And if you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content, and also check out the SBTV podcast on iTunes and Spotify.